Right now, Cipher Mining, ticker CIFR, is trading live at $22.76. That is a staggering move up of $4.11, or over 22% just in today's session. The stock has been on an absolute tear, hitting a day's high of $25.11 on volume that is already triple its daily average. And here's the thing that will make most people pause. This is happening while Bitcoin itself is struggling, down about 3% and trading with a clear bearish sentiment. The immediate expectation, the one that has governed this stock for years, is that when Bitcoin falls, miners like Cipher fall harder. But today, that expectation is being completely shattered, and the reality of what is happening under the surface of this company is forcing a violent reevaluation by the entire market. What we are witnessing isn't a crypto sympathy play, it's a fundamental break from that narrative. The market is realizing almost overnight that Cipher Mining may not just be a Bitcoin miner anymore. It is rapidly becoming an artificial intelligence infrastructure provider, and it just signed contracts that have completely changed its future. The common belief about CIFR and the entire mining sector has always been simple. It's a leveraged bet on the price of Bitcoin. You buy it when you think crypto is going up, you sell it when it's going down. Many investors, whether they are using SoFi Invest or managing their own individual brokerage account, have used it for that exact purpose. It was a proxy, a way to get exposure without holding the underlying asset. And based on that logic, with the crypto fear and greed index pointing to fear and Bitcoin's price dipping, CIFR should be deep in the red. But the reality is that Cipher just told the market that its future isn't solely dependent on the volatile price of a digital asset. Yesterday, the company announced its third quarter 2025 business update, and buried within that update were two developments that total approximately $8.5 billion in future contracted revenue. That is not a typo. $8.5 billion. This changes everything. Cipher announced it has executed a 15-year, approximately $5.5 billion lease agreement with Amazon Web Services, or AWS. Cipher will be providing 300 megawatts of capacity for AI and high-performance computing, or HPC, workloads. This isn't a plan, it's a done deal. The capacity delivery starts in July 2026, and AWS starts paying rent in August 2026. This is the kind of long-term, predictable, high-value contract that companies like NVIDIA stockholders dream of, as it provides the essential power and infrastructure that the entire AI boom is built on. As if that weren't enough, Cipher also confirmed its previously announced 10-year deal with FluidStack and Google for 168 megawatts of AI hosting capacity. When you combine these two, you get $8.5 billion in lease payments flowing into this company over the next decade and a half, completely independent of whether Bitcoin is at $100,000 or $50,000. The market is no longer looking at Cipher as a speculative miner, it's looking at it as a mission-critical data center and power provider for the biggest technology companies in the world. What makes this morning's 22% stock surge so fascinating is that it's happening in spite of the actual earnings numbers. If you just looked at the headline figures from yesterday's Q3 report, you would have expected the stock to fall. Cipher actually missed analyst expectations. It posted earnings per share of 10 cents, while the forecast was for 11 cents. Revenue also came in light at $71.7 million, missing the $76.5 million consensus. In a normal market, for a normal stock, that's a recipe for a sell-off. But the market has completely ignored the miss. It has looked right past the short-term earnings and focused entirely on the $8.5 billion in new contracts and the strategic pivot they represent. This is a classic case study in why online investing is so difficult. The past numbers, the ones that are easy to find on any Robinhood app, told one story, while the future, contained in the press release told an entirely different one. The institutions and high-speed traders who are driving today's 135 million share volume are not trading the Q3 miss. They are trading the 2026 revenue stream from Amazon. This surge is also putting Wall Street analysts in a difficult position. Just this morning, H.C. Wainwright reiterated its buy rating, but the consensus price target from analysts is around $20.40. As of this moment, the stock is trading live at $22.76. The stock has blown past the average analyst target in a single session. This isn't like looking at a mature company like Apple stock where targets are adjusted by a few dollars. This is a complete re-rating. Analysts will be scrambling to update their models, trying to figure out how to value this new hybrid business. How much is the mining operation worth, and how much is the new $8.5 billion HPC hosting business worth? The old models are effectively broken. This is the kind of volatility that makes self-investing both thrilling and incredibly risky. Platforms like Fidelity and Interactive Brokers are likely seeing massive order flow for CIFR today from both retail investors chasing the momentum and institutions trying to build a position in what is effectively a new company. Let's talk about the sheer scale of this move. To fund this massive expansion into AI infrastructure, Cipher also announced it had completed a $1.3 billion convertible note offering. This is the capital it will use to build out the new data centers, including a new 1 gigawatt site in West Texas it's calling Colchis, where it will hold 95% equity. This is an aggressive, capital-intensive move. The company is taking on significant debt to finance this build-out, betting that the long-term, stable contracts from Amazon and Google will more than pay for it. This is the kind of corporate maneuver that can lead to immense wealth or significant failure. It's a high-stakes bet. For investors using tools like Schwab Intelligent Portfolios, which are designed to mitigate risk, a stock like CIFR is a perfect example of concentrated, event-driven volatility that automated systems might be programmed to avoid. But for active traders using the Fidelity trading platform or Interactive Brokers platform, this is exactly the kind of event they look for. So, what does the company actually do? For the past few years, Cipher has been an industrial-scale Bitcoin miner. It builds massive data centers, fills them with high-powered computers, and uses enormous amounts of energy to solve complex problems, earning Bitcoin as a reward. As of its September update, it was running at 23.6 exahash per second, a massive amount of computing power. It mined 251 Bitcoin that month alone and was holding about 1,500 Bitcoin on its balance sheet. This part of its business is still very real and still generates tens of millions in revenue, as seen in the $72 million it brought in last quarter. This is the old Cipher, the one that's tied to the crypto winter and the price of Bitcoin. The new Cipher, the one that has the market so excited, takes that same expertise, building giant, power-hungry data centers efficiently, and applies it to a different customer: artificial intelligence. AI models, like the ones from Google and AWS, require an unbelievable amount of computing power. Cipher is essentially leasing its infrastructure to them, acting as a high-tech landlord. This provides the kind of predictable, subscription-like revenue that investors love, something its old Bitcoin mining model never could. This strategic shift forces every single person holding this stock to ask a new question. What I want to know from all of you watching is this. Comment below whether you think this pivot to AI hosting makes Cipher a safer long-term investment, or if the $1.3 billion in new debt just added more risk. Looking ahead, the future for Cipher is now a two-part story. On one hand, you still have the legacy Bitcoin mining operation. Its profitability will be directly tied to the price of Bitcoin and the operational costs, primarily energy. This will remain the volatile part of the business. If Bitcoin continues its bearish trend, this segment will suffer. On the other hand, you have the new HPC and AI hosting business. This segment is all about execution. The risk here isn't the price of a digital asset, it's construction timelines, energy agreements, and operational uptime. Can Cipher build out 300 megawatts of capacity for Amazon by July 2026? Can it get its 1 gigawatt Colchis site energized and operational? These are no longer questions for crypto analysts, they are questions for industrial engineers and infrastructure specialists. The $1.3 billion in convertible notes also introduces debt risk, where previously Cipher was lauded for its clean balance sheet. This is the ultimate tension between expectation and reality. The expectation was that CIFR was a simple, volatile crypto stock, a name you might trade